Hi, Ed. Thank you very much for joining us today. How are things in Hawaii?
They're recovering from the fires, unfortunately. But it's business as usual, which is good. The economy is slightly coming back here after the devastating fires, but the one thing we're concerned with is the federal government aid isn't all that great, and people are struggling to rebuild, and it's a slow process. So unfortunately, disaster capitalism seems to be rearing its ugly head, meaning the typical developers are going to come in and try to scoop up land from people who need money.
And Ed, how is the tourism business? Is it coming back?
It came back a couple months after the fires, but it's starting to slow again. I have friends that have small businesses, and they're indicating that things are not good right now.
And I have to ask you, Hawaii has many beautiful islands, but what's your favorite island?
The one I live on, Maui.
It's been a few years since I was in Hawaii, but I remember Kauai. I spent a few days there and I was just blown away by the raw natural beauty of it.
Yeah, Kauai is beautiful, and it's breathtaking, but it's a lower populated island. And personally, I like living on Maui. There's more of a cultural center. Kauai is beautiful, but a little more isolated.
So I am based in Toronto and I always complain about the cost of living here. What's the cost of living like in Hawaii or on
Well, the
Maui?
cost of living is always been high in Hawaii. What's interesting is I used to think gas on Hawaii was expensive. It's running around well, at Costco it's at $4. At the other gas stations it's at 4.80. And then my friends in California, in LA, are paying up to $6, $7 a gallon. So I feel blessed in many ways.
Wow, that's incredible. So let's move on now. I want to have a discussion with you on the economy. And you and your team have written a lot about the money supply. And I want to start right here. Why don't you take us through your thesis of the money supply and what it means to the US economy?
Yeah, so go back to 2020. We were what people may or may not remember, in 2019, the global economy was starting to slow, and there was a lot of indications that there might be a credit event because the Federal Reserve overnight window was going haywire in September. But then miraculously, COVID came along and provided an excuse to print unprecedented amounts of money. So COVID, when you look at the spending on COVID, here's a little statistic. From 2009, the financial crisis, to 2019, we grew the federal deficit by 11 trillion, so about a 1.2 trillion a year. And then after COVID hit in 2020, we've spent 8+ trillion. It's growing. Yeah, maybe up to 9 now. I did this as of towards the end of 23. So let's call it 9 trillion. That's about 2.5 trillion a year added to the deficit. And so COVID was a war, but it's war-like spending, and wars tend to be inflationary and reinflate the complex. And one of the bankers of the world have a saying: inflate or die. Deflation obviously is very bad for bankers. So we had an inflationary event occur in 2020 when the Federal Reserve printed 65% more money supply than the previous year, the highest increase in the money supply ever. And money supply and policy moves like that don't happen immediately in the economy. They take some time to ripple through. Usually 1 to 2 years, let's call it 18 months. And so 18 months later, in 21, we started to see inflation, and that's when inflation took off. Then the Fed went on in 2022. They went on their unprecedented rate hike cycle, and we got to remember we had zero interest rates for 14 years, basically, with an attempt at raising rates in 2017, and that increase in interest rates that fast caused the money supply year-over-year growth. So money supply took off after the COVID spending. And that's what the year-over-year growth went like this, and then it plummeted when they started tightening, and it went a negative year-over-year growth for the first time since 1930. And historically, when you go back into the historical record, that's usually then followed by economic contractions and bank failures. What was interesting was when the money supply went negative in November of 2022, there's, like I said, there's a lag on money supply policy moves. So really, the crux of the money supply contraction is going to start hitting the economy in full force, probably this May, and that's 18 months from November of 2022. What was interesting was we saw bank failures in March of last year. If you remember, they were quite scary. Silicon Valley Bank went bye-bye. First Republic went bye-bye. There were one or two others, and what was alarming about that was the speed with which they just disappeared, and they were some of the biggest bank failures we've ever seen. At the time, I did some interviews, and I said the Federal Reserve and the Treasury are going to try to either slow, they want to control the implosion. So, and they did a good job. I thought it could go two ways. Either they lose control or they control it, and they did. The Bank Term Funding Program kind of put a finger in the dike, but that program ended March 11th of this year. And we see New York Community Bank, hitting new lows in its stock price. They ran into trouble. So I think there's going to be regional bank consolidation and bank failures going forward. So that's going to be a problem because that's less credit in the economy. Money supply going negative is going to be less credit in the economy, and less credit means less economic activity. This should have caused a decline in the financial markets, but it didn't. And the reason is that the government stepped in at the Treasury, and that we're seeing unprecedented government spending that's really kind of given these quote unquote good GDP numbers. So if you break down what's going on in GDP and in employment, mostly government jobs. And what do we know about a government job? It's not there's no productivity associated with it. So this is, in fact, it might be, you could argue it's negative productivity. So in the short term, it provides a stimulus. In the long term, it's going to reverberate back into a less productive economy. So where we sit right now is we have money supply really going to start affecting the economy this May, we think. Our economic cycle indicators are still in recessionary levels. That hasn't occurred in the numbers yet. But what's interesting is they went down, hit a low last year. They started to rise, but they petered out, and we've seen this before in our economic models. There's a kind of a dead cat bounce. We think we're there, and the Federal Reserve is also, it's an election year, and the Federal Reserve is doing a quiet, stealth QT taper, quantitative. So they're tapering without really talking about it, and then they're talking about tapering later. But they're doing it right now. Actually, it's kind of their quantitative tightening is less and less every month if you look at the numbers. So it's an election year. They're spending like crazy. They're going to try to hold this thing through November.
So let's just summarize all of that. So when you talk about the money supply, the money and the components of the money supply, that's the fuel to drive the economy. When there's a lot of money in the system, I'm jumping on a plane, I'm flying to Las Vegas, I'm going to see U2, and I'm spending $25 for a drink. And so I'm helping to stimulate the economy. Conversely, when there's a contraction within the money supply, there's less money in the system, and I'm not jumping on a plane and flying to Las Vegas or some other place.
Yeah, it kind of has knock-on effects, but it starts with the banking system. So the banks make less loans. Loan standards are tightening, and that just slowly reverberates throughout the economy. And usually small businesses get hit first. Corporations don't tend to have a problem because they can issue debt or equity in the capital markets. But there's a lot of zombie companies out there right now, and right now credit spreads are tight. We expect those to start widening sometime late summer, early fall, at which point we think that's when the reality in the financial markets hooks up with the reality in the real economy. So as crazy as this may sound, the stock market is at all-time highs. It's probably gonna have a little correction scare soon. Then it'll rally to a new high in the summer, when we look at it technically. And then from there, things get very interesting. The stock market went down a lot in 22. Then it had a tremendous rally since October of 2022, and it really took off at the end of 23. But the makeup of that market is different than the rally into the top in 22. The rally in 22 was all stocks kind of participated. You've heard of what everyone's talking about, the Magnificent Seven. So this is a really bifurcated market, and it's being held up by these mega cap stocks, and that usually can't sustain itself. And it's risk reward here is very, very bad. And if you have if you're a trader, good luck to you. But if you're like a long-term investor and you have a 5 to 10 year time frame, risk here is quite high.
And I want to ask you one more question about the money supply. When you talk about the contraction in the money supply and the current situation we find ourselves in, when was the last time, or how does this time compare to other cycles?
Well, the money supply started coming down before it went year-over-year growth negative. So it peaked earlier in 2022, and then started coming way down when the rate hike started. It went negative in November of 2022, year-over-year growth, and that's the first time since 1930. And we looked historically. I have a friend, Tim Wood. He's a cycles analysis. He's got his own work. You can go look at cyclesman.com. But he went back all the way to the 1800s, and every time money supply went year-over-year growth negative, it was associated with a banking crisis of some kind.
And remind me again, what's the lag effect associated with the money supply or contraction?
18 months. So there was an 18-month lag on inflation from the 2020 spending, and then there'll be an 18-month, we think around an 18-month lag with the contraction, which honestly, it could hit any time between now and summer. But we suspect, given what the Federal Reserve is doing and the Treasury is doing with their fiscal irresponsibility, they'll be able to kind of hold it up a little longer, but not much longer.
So you made mention of how strong the economy is, and it's growing at 5% annualized, give or take. We've also had 25 consecutive quarters of unemployment below 4%. The last time we saw that was in 1969. You made mention of the fact that the stock market is trading at all-time highs, and numerous stocks. Of course, I got to talk about NVIDIA, but I think it's up 80% on the year. Bitcoin is up 50% on the year, so it's definitely risk on. But if I was to take the other side of your argument, it looks like everything's great. What am I missing? Hi, I hope you're enjoying the interview. One of the reasons we do these interviews is to help you understand what's happening in the global economy and also how to prepare for it. And during times of uncertainty and also never-ending inflation like we're going through right now, investing in physical gold is one way to protect your portfolio against inflation. If you would like to learn more about gold and how it can benefit your portfolio, visit hardassets.alliance.com. Hard Assets Alliance is a trusted platform that is used by over 100,000 institutional and retail investors. Once again, that's hardassets.alliance.com. There's a link below in the show notes. Now back to the interview.
Well, yeah, everything's great except the real economy. The real economy isn't doing well. The unemployment numbers are, we think, at this point, getting to the point of fraudulent. If you look at what happened in 2023, every payroll number they reported, they revised down. So, to the tune of 1.5 million jobs for the full year 2023. And most of the jobs that are being reported are government jobs and or part-time jobs. They call it the gig economy. And what do we know about that? We know that low-paying jobs, and if you need 3 of them just to make basic needs, that's not a growth model.
Yeah, that's a very good point. I might have to be taking one of those gig jobs. So,
I agree.
so you also touched on the debt levels in the US, and right now the federal debt is around $35 trillion, and it's actually growing by, I believe it's $1 trillion every 100 days. Is that correct?
That's correct.
Like it's just mind blowing what's happening. But so let's talk a little bit more about the debt. And listen, we've both heard about the debt levels for decades now, and yet the economy continues to push ahead, and it really has no long-term impact, or so it seems. But you think otherwise?
Yeah, so let's look at the numbers. So when the great financial crisis happened, I think we were at 60% debt to GDP ratio. We're at 120% now. In addition, during the great financial crisis, if you look at all public debt, state and local at the end of the financial crisis, 2009, was 30%. And since then, that ratio, and the government was 70%, the federal government. Since then, that ratio has gone to 90% federal, 10% state and local. Why did that occur? Well, it is a little history lesson, but there was a lot of concerns after the great financial crisis that states and municipalities and counties would go bankrupt. Well, the federal government has been subsidizing their budgets. So if you look at the budgets, most of the states get an injection from the feds. That's also caused kind of a centralization of power. So the states governors, especially in Texas and Florida, when they talk a big game, they still are beholden to the feds for a lot of their budget. So the federal balance sheet has been subsidizing state and local, and now we're at 120%. And at some point, that becomes unsustainable. And I would say that growing the deficit $1 trillion every 100 days, we're getting close. We're getting close. So something's got to give, and it's just a matter of time.
Yeah, it's truly remarkable. Like if you and I are talking in a year from now, where's the debt level going to be?
Well, let's see, a year, another 3 trillion, so 37, 38.
Yeah, what's another $1 trillion? So let's talk a little bit more about the regional banking system. You touched on that in Silicon Valley Bank, and I would agree with you. It's amazing how fast the feds were able to contain that so it didn't spread. But now we have this issue with the New York Community Bank. And I guess my question to you is, do you think there's more coming?
Yeah, there's definitely more coming, because there's two things going on with those banks. That we call them the regional banks, and they for 14 years had zero. Were paying zero on their deposits, and that's the liability side of the balance sheet, and their assets were loans and treasuries and corporate bonds if they bought them for their portfolio to make the spread. But banking is nothing more than lending short, borrowing short, lending long, and you make an interest rate spread, because most of the time the interest rate curve is positively sloped. Well, when the Fed went off on its unprecedented rate hiking cycle, people started to notice, and so they had all these bonds in their portfolio, some of which were just simple, safe treasuries, and those went down 30% in price. When you go from zero to, treasury bonds, safe bonds, so that they went down in price. So their mark to market was, now this is mark to market held to maturity, so they weren't bankrupt right away. But on the liability side, the deposit side, they couldn't raise the deposit rate that they pay to their savers fast enough, because they didn't have the app. So that they would have started losing money had they matched the Federal Reserve's new rate of eventually 5.5%. So what happened in March of 2023, and it started happening prior to that, people were starting to figure out, well, I got $50,000 in my savings account earning zero. I can go buy a 3-month T-bill for 4%, 5%. So it's called a disintermediation of the regional banking system. So their deposits started to go. So what the Fed did when that became apparent was they made loans to these banks, but the deposits are still continuing to flow out because the current interest rate on a money market fund or a UST bill is 5.5%, and they have not raised they're not competitive in the marketplace. So that's number one. They're losing their like I said, they're borrowing short, lending long. So they're losing their liability. Their deposits are flying. Now we're coming into an economic contraction, and credit will start to sour. That's already started in the commercial real estate market, and a lot of these regional banks have commercial real estate exposure. So as time rolls, they have two problems: deposit flight and credit problems. So that's why I expect to see more problems in the regional banking system. And I suspect we'll see some shotgun marriages between those banks and the big money center banks over the course of the next 2 years. And it depends. It may not happen for a couple more months this year. We might not, New York Community Bank may get sold to somebody, but, I just know in the next 2 years, we're going to see some sort of movement on that. And, quite honestly, at the time the Silicon Valley Bank and the other ones failed, I said, this is if you wanted to issue a central bank digital currency, it'd be easier to do it with only 6 major banks in the US rather than the current number, which is hundreds. So it's a lot easier to do a CBDC if you don't have a bunch of banks.
And I want to have a discussion with you on that. But before we do that, let's just summarize a lot of the points that you've just made. So first of all, in spite of the fact that the economy is growing at 5%, that the S&P and the NASDAQ are trading at or near all-time highs, you think we're in for some trouble and in both the economy and also the stock markets. So maybe you can just expand on that and what will be the catalyst to take everything down?
Well, typically, so we got an election in November. There's going to be a lot of uncertainty associated around that. And markets top when there's a lack of buyers. So we're in a kind of a bubble in 7 stocks. Nvidia is up 80%. It's got its market valuation is the same as all of the Chinese stock market. So, what do we know about bubbles? When they burst fast and quick. Nvidia is being pumped up because of the excitement about AI. And what do I know about semiconductor companies? They're cyclical. So at some point, it's going to be valued like a cyclical company. And again, that's why I think the stock market probably peaks late summer. So you really don't need a catalyst. It's just, and again, the money supply will be the contraction from the money supply will be hitting. So liquidity will start drying up. So really, if you're playing the trading game here, day trader, you know what you're doing. But if you're a long-term investor and you're putting new money to work today, I think you're not going to be happy in 2 to 3 years.
And what sort of pullback are you looking at in both the economy and also in the S&P?
Well, it's hard to gauge that because one of the problems right now is that the stock market is actually one of the biggest assets to the Fed and the U.S. government, in that it creates the only thing we have left right now. We have no manufacturing jobs, we have government spending, and we have the wealth effect from the stock market. And so the stock market needs to be saved at all costs. So it depends on what we see from the response from the Federal Reserve once the contraction happens. So, I'm thinking anywhere from a 30 to 50% drawdown. And then they'll try to save it. If it goes below 50, that means they've lost control. Because traditionally they've been able to save it at a 50%. We had a 50% drawdown in 2000, 50% drawdown in 2009. Anything more than that, then we have what we call Great Depression type retrace, where you retrace 90%, 80% of all the gains. So I can't tell you until I see what the Fed and the government does. But they'll do something. And I think that's when they introduced the CBDC.
Okay, so let's talk about that. Hi, I hope you're enjoying the interview. One way I use to protect my portfolio against the constant erosion of inflation is with physical gold. And if you would like to learn more about the benefits of owning gold and how to buy it and how to store it, visit hardassets.alliance.com. Hard Assets Alliance is a trusted platform with over $3 billion in assets, and it's used by over 100,000 institutional and retail clients. They offer American Eagles, Canadian Maples, South African Krugerrands, and also gold bars. Once again, that's hardassets.alliance.com. There's a link below in the show notes. Now back to the interview.
Yeah, I mean, look, the CBDC is for me personally, I think it's I'm against it because I know the abuse of power that can be made with it. You can link it to everything, so you can start to impose social controls on people. You can debank people and turn off their bank account if you want to. So it's kind of a modern day slavery system. And if they wanted to, if somebody got into office and said and was a vegan and said we're going to impose meat quotas, technologically they'd be able to prevent you from buying more meat at the grocery store, meaning the clerk couldn't even transact for you. It's that kind of control, and that kind of control we always know will be abused. So I love cash. I've been to protest. I spend cash as much as I can in all restaurants, and when I go out shopping, I pay in cash.
Well, we've actually had a situation here in Canada, of all places, if you can believe it, but where the government actually did that very thing against the trucker convoy. I believe that was 2 years ago, but I'm sure you read about that.
Yeah, no. So that was a beta test, and what they didn't count on was the moment they did that, the blowback was huge, and there was an immediate fear in the financial markets where if you were outside of Canada and you had money in Canada, you said, "I want my money back." So there was actually a drawdown in the banks figured that out pretty quick. They started seeing fast movement, and I think they went to the Trudeau folks and said, "You guys, no."
Yeah, it's hard to believe in all countries in the world. I would never did I ever think that would happen in Canada. But don't they have central bank digital currencies in China?
You know, I don't know if they do yet. I think they're testing them. But they have other methods of control. I mean, they have social credit scores. So, they have an AI system where if you go online and you say bad things about the government, you can't get an airplane ticket. You can't. So I don't think it's a CBDC. It's more just a monitoring system that is pretty Orwellian, so to speak.
And the whole motive or objective behind implementing central bank digital currencies is just to control the population. Is that right?
Well, I think ultimately that's the people who are pushing this. That's what they want. I think there are a lot of players in it that they think it's great and it's convenient, and I think they're just naive. We've seen there's a famous clip of a Bank of International Settlements banker speaking about how you can control many things with the CBDC, and he basically revealed the plot.
And
he said we can control how people spend their money. I mean, he said it.
And how do cryptocurrencies fit into this whole thesis?
Well, cryptocurrency. I mean, I'm not a Bitcoin or crypto expert because I'm 56. I kind of miss that, but I think they're legitimate alternatives. My only fear would be if there was a solar flare like in the 1800s, the Carrington effect, and we lost all of our electricity. What's Bitcoin worth with no electricity? So that's like a black swan event. So you can't worry about that. But I do think cryptocurrencies are legitimate, especially Bitcoin. There's a lot of speculation and fraud in the crypto world. We've seen, fraud in the crypto world. So like any new market, it's the Wild West. But I think cryptocurrencies are around to stay because people view them as an alternative to run amok central banks and government spending.
Ed, you have written in the past that a Trump-Biden rematch would be the worst possible outcome, and it looks like we're going to have that. Why did you say that?
Well, because the choice is between. So Trump will be a lame duck president. So he's already served one term. So he'll get in there and he'll be a lame duck president right away. Biden is corrupt and old and a puppet, in my humble opinion. And we're going to see come this fall a strategy by the Democrats to remove Trump from the ballot and or put him in jail. And that's going to cause a lot of societal angst and anger. And the two camps are completely living in different realities. And I'm not going to argue which one's more real, has a better grip on reality. But when you have that kind of polarization, where people look at the other people as the others, it's a toxic brew. So I think we're going to see things we've never seen come this fall. And I do think as we get closer to the election, the capital markets will start to become very nervous because the rule of law will come in here. There'll be a lot of chaos, a lot of protests, a lot of it's going to be bad. It's not good.
It's going to be interesting times, that is for sure. And then when we look out into 2025, especially when it comes to the economy and the financial markets, what do you think happens?
Well, so like I said, I think stock markets kind of peak out this summer, and then again, it can be a 2001 kind of decline where it takes 2 years to go down 50%, or it can be fast. I don't know, but what I do know is if Trump wins, then they're going to lay this recession at his feet. If Biden wins, they'll try to hold it up, but I don't think they'll be able to hold it up for very long. So we're looking at end of 24, beginning of 25 as a very turbulent time. And again, because of the money supply going down in November of 22 and still down there, this could happen at any time. So like I could be wrong. This, we could blow up now, and there's black swan events out there that could derail this. Like the Bank of Japan is having problems. There's currency issues with the yen right now, and the yen carry trade has been a big funder of global financial assets for a long time, and the yen is flirting with a technical level that's very scary to the Bank of Japan. It's the U.S. dollar Japan trade is valued at 151 right now, and if it breaks out much higher than this level, that could cause some turbulence. So Japan is faced with a difficult choice. They need to either keep rates low or raise rates to stave off inflation. And do they save the global economy or do they save their own economy? That's something the Federal Reserve can't control. Right now, there's been a lot of central bank coordination, but at some point, this global debt problem we've had gets the release valve always has been currencies. So if we have a currency crisis in the major major economy like Japan, it'll have knock-on effects throughout the global financial system. So that could occur at any moment.
And let me just expand on that a little bit. Okay, so you're saying the U.S. or the carry trade that everybody was doing in Japan, they were basically borrowing money in Japan and then investing it elsewhere throughout the world?
Yeah, correct. I mean, Japan has been zero forever, and the yen has been pretty stable. But the problem has been since COVID, Japan has printed way more money than anybody, and I think their own Bank of Japan's assets are at the same level as their GDP, annual GDP growth every year. So that's the ratio. The US is at 25%. So our Federal Reserve's balance sheet is at 25% of our annual GDP. Japan's ratio is 1-to-1.
So if they do start increasing interest rates,
So the point is the yen needs to devalue, and they're trying to prevent that. But at some point, the market's going to figure out the yen needs to go a lot lower and devalue,
and
that'll blow up the yen carry trade, and that'll be a giant global margin call. But again, that I can't predict when that's going to happen.
Fascinating. Ed, as we wrap up, you have painted a picture of a very negative picture with the economy and the U.S. markets. And if there was one thing that might derail your whole thesis and where we see the market continue to go higher, what would it be?
What would it be? Well, if Biden decided to reverse all his economic policies, if he unleashed the energy complex and drove the price of oil way down, if he started to do what Trump was trying to do, bring manufacturing jobs back. I mean, if there could be, if he could reverse his policies, that could be something I don't see, but I don't think he's going to do that. And then a Trump victory could give a lot of optimism, but I do think that there's so much pent up dislocations in the global financial system that I think Trump will have difficulty his first year of his first term, second term, I mean. So there'd have to be any kind of reversal of policy would blow up my thesis. And I want to say something about interest rate cuts. So the Fed is on pause. And people need to understand something about what happened in 2000 and 2007-8, before the downturn of the financial markets. The Federal Reserve had been in a policy of hiking interest rates to cool the economy. They then paused, then they started cutting. Cuts are generally viewed as bullish, but not when you're going into a recession. They're very bearish. So the Federal Reserve, I think, is pausing because they're seeing what's going on in the credit complex, but they're not talking about it. And if you see short-term interest rates start to really go down quickly, that's a sign of bad things coming.
Well, that was a fascinating discussion, and it sounds like the back half of 2024 is going to be an interesting one, to say the least. And I want to thank you for making time with us today, and I look forward to our next discussion.
Thank you, James. Good to be here.